what was really normal about pre-COVID and what is really normal now? How can we ever go back to where we were before? Because we've added on a tremendous amount of additional debt.
Hey everyone, this is Elijah K. Johnson with the Miles Franklin Market Update. And with us today is Michael Pento, the founder of Pento Portfolio Strategies. Michael, thank you so much for joining us today.
So good to be back on with you, Elijah.
Definitely. Now, it's definitely an interesting year we've seen. And since we've talked, a couple of years ago, so much has changed. I would like you to address this and kind of this whole COVID situation. I know you recently wrote about the COVID vaccine and the multiple vaccines that are coming out now. And people are saying, well, could things get back to normal? Your point is that even before COVID, things weren't normal. So where would you like to start, Michael?
Well, first thing that comes into my mind is like, what's normal anymore? Is normal a Portuguese 10-year note that yields less than zero? I mean, if you remember back in 2012, during the European debt crisis, you remember we had the PIGS, so it's Portugal, Italy, Ireland, and Greece, and Spain. So these were the countries where the just insolvent nations that were begging for the ECB to come buy their debt. Well, the Portuguese 10-year note went to 15%. And now it has a minus sign in front of it. So, I mean, what's really normal? Is it normal for, let's just go back to pre-COVID in 2019 in this country. The year-over-year growth rate was 2.2%. This was before anybody heard of a Wuhan virus or COVID-19 or SARS-CoV-2 or whatever you want to call it. So we had very anemic growth rate, but also remember that the Fed had to go back into QE and lower interest rates to save the repo market, which had completely frozen over. Repo rates shot up above double digits. So, what was really normal about pre-COVID and what is really normal now? How can we ever go back to where we were before? Because we've added on a tremendous amount of additional debt. We now have $17.5 trillion in total non-farm business debt. That is an all-time record high in this country. Never before even close nominally and even as a record, a record percentage of GDP. So what is exactly normal, Elijah? We have a condition now where central banks, not just the United States, central banks around the world own markets. The ECB, which came out today and increased their quantitative easing by 500 billion euros, they're slated to purchase 70% of all issuances from European central banks. They have individual banks in Europe. There's an ECB and there's individual banks. So all sovereign debt, 70% of all sovereign debt to be issued is going to be purchased by a European central bank. How is that normal? And the same can be said for Japan. The Federal Reserve is printing $120 billion every month. And they're not just buying treasuries any longer, as you know, they're buying mortgage-backed securities. They've taken interest rates down so low that a 30-year mortgage is below 3%, it's 2.9%. That's not normal. So they're purchasing junk bonds, as you know, municipal bonds, all kinds of corporate debt, including high yield, as I just said. So there's no escape. There's no normal anymore. You have to ask yourself this question: how can central banks extricate themselves from this trap innocuously without causing massive damage to the markets in general? And that includes the bond market, the stock market, the real estate market, and the economy as a consequence.
Now, when it comes to people saying, the vaccine could bring things back to normal, obviously it wasn't normal back before COVID, but you've also pointed out that there are it might not be a cure-all even for COVID itself. We could see the virus mutate. And so what more risks are there with respect to this COVID crisis?
Well, there's a lot of risks, Elijah, because everybody seems to be on the same side of the trade right now. The zeitgeist now on Wall Street is that, well, hey, we have these vaccines coming, and that's going to bring us back to not only a normal state of growth, which would be trend growth, which is around 2%, but I'm hearing 6, 8% in 2021. So the money to be made is to bet against that happening. And what would cause that growth to not become manifest? Well, in my mind, number one, actually there's two things. So the number one would be a disappointment, God forbid, with the vaccines. And by the way, I'm not against vaccines in general. You get to ask yourself questions, how many people will take the vaccine that was developed at hyper warp drive speed? Will it be safe? How effective will it end up being? Does the virus mutate like the flu virus does? So how many inoculations are needed? Do you need 2? And that lasts for 5 years? Or do you need 2 every 6 months? Then you get into the logistics because this virus is extremely, extremely contagious. It's a virulent virus. So you need to constantly inoculate the population. So that's number one. We hope things work out, hope and pray that it works out. But I'm reticent myself to take the vaccine because you can develop a vaccine at warp speed, but what you can't do is speed up time. So we don't know yet the long-term effects of this vaccine. We just don't know because it takes time to see if there's any long-term effects. So that's number one. Number two, and this is the other issue I'm very much worried about in the second half, say Q3, Q4 2021, is interest rates, Elijah. I'm very much concerned that if we do have a scenario that causes not only a normalization of growth, which would be something close to trend growth, and a return of inflation above the Fed's target on core PCE, which is 2.5, meaning the real rate of inflation will be double digits for you and I, then the Federal Reserve will vastly attenuate. They should. They won't raise rates. That's off the table. But they should start to vastly attenuate its pace of QE, which means you can get a rise in interest rates, a rise of interest rates. But when you talk about a rise in interest rates, normally you would think, well, the normal rate on the 10-year note should be around 6 or 7%, and say the normal Fed funds rate would be about 4%, 4 or 5%. So you'd have a small increase in interest rates, 100 basis points, 200 basis points, and that might be innocuous for the economy. But when you're talking about an interest rate increase from 0, T-bills are now 0. So going out a whole year, Treasury bills are basically yielding 0. But if they were to go from 0 above to where the Fed funds rate should normally be, which is 4 or 5%, and the 10-year note goes back to 6 or 7%, and why wouldn't it? I mean, if the Fed was going to stop quantitative easing and we had a normal rate of growth, nominal growth of around 4 or 5%, so nominal growth plus inflation, so real growth plus inflation, sorry, nominal growth would be about 4 or 5% GDP. Well, why wouldn't you have interest rates that high? Well, the only reason why you wouldn't is because look what's going on in the ECB. I mean, if you're not gonna have a U.S. 10-year note trading yielding 7% or 6% when the Portuguese note is 0. So this is what I think could be a globally synchronized attenuation of QE. Whenever that happens, I'm not saying it's going to happen next year. I'm saying I'm watching out for it. It's what could happen because logically you can't believe that central banks can print hundreds of billions of dollars worth of counterfeited money every month without any kind of consequences. So you're eventually going to have them dial that back. And if we have that dialed back in the context of a normalizing economy, you're going to have an interest rate spike, which would end up being devastating for markets. You think about junk bonds right now. Junk bond yields are the tightest to treasuries ever. The nominal yield is the lowest, and the spread to treasuries is the tightest. So there's a lot of room for destruction, especially when you think about the zombie companies now represent 20% of all listed shares. 40% of all listed companies don't make any money at all. So there's a lot of room for carnage, which of course, after the Fed and the ECB and the Bank of Japan attenuated their purchases of bonds, you'd have this big spike in bond yields, and that would destroy the economy. The economy crashes, the stock market crashes, and of course, that would bring them back in. So what I do here at Pento Report is I model those dynamics and try to capture those cycles of deflation, inflation, recession, and growth.
With respect to that, are you bullish on gold and silver right now going into 2021?
Okay, so just to backtrack, in early part of this year, early 2020, I thought it was one of the best environments for gold I've ever seen in my career. And I was very long the metals. I had about 15 to 20% allocation to physical gold, and I had a 5 or 10 allocation to the miners. We did very well in the portfolio. I sold almost everything. I sold all my miners a few months ago and almost all my gold. I only have a 5% position in gold. And the reason for that is because, well, first of all, I manage money. I'm an active manager. So I buy and sell. I change my allocation frequently. So I'm not talking about, for your audience, yes, own 5, 10% of your assets in physical gold, put it away, don't worry about it. But if you're an active manager, I sold a lot of my gold exposure, precious metals exposure, because I realized in the short term, real interest rates would be rising. Okay, and you saw exactly what happened. We saw the 10-year note go from 0.6% to almost 1%, 0.95, 96, 98, exactly at the high. So nominal rates were rising, yet at the same time, the rate of inflation wasn't catching up to it. So that equates to a rise in real interest rates, which is the bane of gold. Now, bear in mind, gold has had a spectacular run, and it's probably going to do very, very well in the second half of 2021. One of the reasons is because the comparisons between Q3 2021 and Q3 2020 are devastating. They're very hard. So the growth rate is, 30% plus GDP growth in Q3 2020. It's hard to come anywhere near that. So you'll see a slowdown in the year-over-year growth rate, which should bring nominal rates and real rates down, which would be great for a great reentry into the gold market. That's how I look at the precious metals market. But longer term, if you have a longer term outlook, since I just mentioned to you, explained a good part of this interview on how central banks can never escape the trap they're in, then if you have this protracted secular view on metals going out decades, then just continue holding them. But if you're like me, and I did make the correct move. Miners got hit pretty significantly, down 25%, I believe, from their high a few months ago. Gold is pretty much, topped out and kind of stable where, topped out and then came back a few percentage points and is stabilized. I'm just trying to maximize the return in my portfolio. Again, probably around Q3 2021 would be a great time to go back into gold. That's what the model that I created is saying now.
Now, with respect to the gold and silver prices, what is your perspective on, some people have argued that it seems like gold and silver are manipulated, and some people argue that it's even suppressed. Do you see evidence for that in your research?
Of course they're manipulated. Everything is manipulated. I mean, even LIBOR, the London Interbank Offer Rate, is manipulated. So anytime you have human beings and money, lots of money involved, there's going to be corruption. This shouldn't shock anybody. But the thing is it manipulated always to the downside? No. I mean, Wall Street, they're like the three little pigs. I have a poster of that in my office. Wall Street is about greed. They don't care what they're manipulating. They manipulate things to the downside and to the upside. Now, governments try to manipulate gold always to the downside, but Wall Street will manipulate it either way, say bullish or bearish. Just think about the fact that gold has outperformed. Physical gold has outperformed the S&P 500 in the last 20 years. If it was manipulated by Wall Street and by governments always to the downside, that would never be the case. So I would like to be on the right side of that manipulation. And again, when real interest rates are falling, which I believe will be the case in the second half of 2021, Wall Street will stop manipulating gold to the downside, take a long position, and start manipulating it to the upside. And that's when we can make a lot of money in the sector.
What is the perspective that an investor should have? You're saying all markets are manipulated. How does someone invest accordingly? I mean, does this manipulation really impact investors at all?
Sure it does. You just have to know, what runs the machines on Wall Street. How do the algorithms manipulate prices? So if you understand that, and like I just explained, so gold isn't, people think it's mostly concerned about maybe geopolitical strife, or maybe its main focus is to hedge against a falling dollar. These are all components of it, but the primary function to the price of gold is the direction of real interest rates. And if nominal rates are falling and inflation isn't, or deflation in this case, isn't falling faster than the rates are falling, then you're going to get a fall or a reduction in real interest rates, which is the primary mover of the price of gold. That should be the case again in about 6 months.
With respect to the mining stocks, are you bullish maybe going into mid next year? When are you bullish on the mining stocks?
I would be much more bullish on the mining shares as we approach third quarter of 2021, as we see real interest rates once again begin to fall.
All right. Well, one last question before we let you go. What other assets are you looking into going into 2021?
So right now, I believe, and I run an active fund, so don't mistake me as a perma bull. But I've been switching from the miners. I switched from old wall tech. I call it the deep state of Wall Street. They love Facebook and Apple and Amazon and Google. I kind of switched from any exposure I had to those to roll into value. So small cap and value has been working very well for me. I actually purchased a lot of green energy stocks that have done very well for me because the election I thought was going to go, not being political here because I voted for Trump. So don't accuse me of being a ardent Democrat. I'm a libertarian, if you want to know exactly what I am. So I saw the election going towards Biden. So I gravitated towards clean energy, green energy. So that's also been working very well for us. So that's probably will be the case where you see the zeitgeist of Wall Street preparing people for this secular trend in growth, a value from growth, big tech growth, big tech, and that'll probably all come to pieces if I'm correct, and I can always change my mind. I have start to predict the weather going out 6 months, but I believe we'll have another chance to rotate back into the utilities, the low volatility stocks, precious metal stocks, dividend proxies in the second half of 2021.
Well, Michael Pento, thank you so much for joining us today. Before we let you go, any last thoughts you'd like to add, and where can people find you online?
So the website is pentoport.com. My email address is mpento@pentoport.com. If you want a way if you have around $100,000 and you want a way to ride out these bubbles in a more safe fashion, in other words, you can't just buy and hold the 60-40 allocation that Wall Street tries to purport on people. It just doesn't work. Both are in a very big bubble, and they're both very dangerous. I didn't mention that the market cap to equities now is 185% of GDP. It's an all-time record high. It's 120 basis points, about 120 percentage points. I'm glad I corrected that. 120 percentage points above its long-term historical trend. So this is the bubble that the biggest bubble we've ever seen in the stock market. Of course, the biggest bubble we ever seen in the bond market as well. So you can't just hold a balanced portfolio because, when you have both bonds and stocks in a bubble, they crash in tandem. Then one is not a hedge against the other. So if they crash concurrently and the Fed is at zero and in some kind of QE, you can't be assured that the stock market is going to rebound in a few years like it usually does. And if you're approaching retirement, you can't wait 7 years to hope to get back to even like you did in 2008. So that's what I will specialize here, riding bubbles in a more safe, intelligent fashion. And then the goal here is to also protect and profit from cyclical and secular bear markets. And that's what you'll get here at Pento Portfolio Strategies. The office number here is 732-772-9500. And I also, if you go to the website, I have a podcast, a weekly podcast called the Midweek Reality Check. You get, I think, 5 weeks for free. And then if you like what you hear, it's only $49.99 a year. And you get a lot of good information you won't see readily promulgated on the mainstream financial media, either because they don't know it or they're afraid to tell you about it.
All right. Well, Michael Pento, once again, thank you so much for your time, and God bless.
God bless you too, Elijah. Good to see you.